is Avijit Chatterjee recording our weekly session for Chartsarefun. This is for the week of August 3rd, recording this on this afternoon of August 9th. Our Substack site is chartsarefun.substack.com. We publish daily blogs. Appreciate you subscribing to it. And then our YouTube channel is also at Chartsarefun. We don't share investment advice. Our goal is to really share fun chart patterns that you can use in your just to guide you in your investment decisions. So again, please realize we're not registered investment advisors. So the intent of this video is not to share investment advice, but to share fun insights and patterns on charts. Today, we're going to talk about the 10-year yield. We've touched on this before. A key signal that we're watching is 10-year yields going to break above a key level of resistance at 4.8. And if that does that, it could be very ominous for the stock market. It could imply a climb if it breaks 4.8 all the way towards 6%. That said, the daily chart of 10-year yield, 10-year Treasury yield called TNX, reflects what we call as a rising wedge pattern. That typically indicates some form of a topping of yield and then maybe a reversal lower, which we had talked about last week. And that's what kind of happened. Last week, it peaked on Friday at 4.747, almost near 4.75%. The entire week from there, it fell from that level. Negative divergence happens when you climb and RSI is at a weaker high. That indicates a topping pattern. So in that case, if this is what will continue its decline, then typically rising wedges come back and end where they start from, which in this case is 4.36%, 43.63 is 4.36%. We have both RSI and MACD with negative divergence. And that's what we're going to watch. Now, however, if what happened on Friday, we did non-farm payrolls came out. There was 23,000 jobs that were lost for the month of July. Market was expecting a gain of 80,000 jobs. So yes, there was in the government, local governments, in the leisure hospitality, we know that there's been trending of lower jobs after the World Cup, Soccer World Cup, because those jobs were temporary jobs that were added and now they're gone. So those were perhaps seasonal things. In summer, we do tend to see loss of jobs. So that's what the market has to watch. That said, the Fed is watching inflation. So we have CPI and PPI coming out this week on Wednesday and Thursday. Those are key levels for the market to watch. That's on the 12th and the 13th of August. On Friday, when the jobs data came out, at least from the beginning of the morning, 10-year yield came to a level of 4.6. From there, it reversed almost towards 46.72 was the high and ended at 46.6 or 4.66%. So that was like a 6 basis point climb through the day and ending at 4.66. What this printed, that candle that you just see right there, is in many cases a doji, but in particular, this kind of a doji is a reversal kind of candle, which could indicate higher yields. That's what you're going to watch. This is called, in technical terms, a dragonfly doji with a long tail in the bottom and kind of a short body towards the top of the candle. So this dragonfly doji, if it turns to indicate higher yields ahead, that would be negative for the market. However, what's directly correlated to lower yields is the small caps. And if you look at the Russell 2000 ETF, this is the iShares Russell 2000 ETF IWM, this seems poised for a cup and handle breakout higher. We can see that the left rim of the cup was at $302.72. It from there formed a cup with a low at $287, hit the right rim of the cup higher than the left rim at $303. Formed a shallow handle. We closed near 301.56, the high was 302. So if we are managed to break above 303, from a 287 to a 303, we are talking about roughly 16 points. Add to 303, 319. So 318 to 319 is this cup and handle target of IWM. And if yields continue to come down, so we talked about the yields in this case, had come down last week. On Friday, it, however, printed dragonfly doji. But if this is just a negative, like a signal that gets invalidated and yields continue to come down, then expect the small cap ETF IWM to break out higher. That's what we're going to watch. Another key cup and handle we are watching is in the NASDAQ 100 ETF QQQ. What we see here is a declining channel. It tested the top end of the declining channel at 728, higher than a previous high towards early July at 726. So if that's a cup, 661 to 728, and then like the IWM, if this is a handle and a breakout higher, this could mean significant higher, at least the measured climb from a 661 to a 728 is $67. At 67 to 728, that measures to 795. There are many who put a target near 800 for QQQ. That's what the bulls will look for. And if this cup and handle breakout does come, this could indicate continued momentum in the Magnificent Seven stocks. We know that Amazon reacted quite strongly, so did Microsoft. So expect continued climb on those. Google fell for a few days after earnings, but then came back extremely strong. So expect Google to have its breakout and continue to higher highs. And then the semiconductor stocks, and above all, Nvidia's earnings is going to come out later in August. That could perhaps see upside momentum as well. So that's what we're going to watch is QQQ. If this cup and handle turns out to be a bullish signal, then that could mean the market continue to coast higher. However, on the defensive sector, a sector that also is correlated to Treasury yields. In fact, when yields fall, utilities get a bid because utilities are safe haven for baby boomers, for people who prefer income. You do get income out of Treasury ETFs like TLT and Treasuries in general, monthly income, but the dividend income from utilities, which are safe haven and often climb when yields come down. So if the yields come down, if TNX continues to come down, then maybe the utilities could get a bounce, XLU in particular. This is the Spider Utility ETF. This shows negative divergence, higher highs in price from 45 to 47, lower high in RSI, lower high in MACD. If this has a breakdown, however, we can see that it's testing a key trend line. To higher lows, 40, 41, 42.8. Recently came in and rebounded from 42.94, slightly higher low from the previous low. If this rebounds higher, this could be a defensive play because utilities tend to be a defensive play, and also a play with yields coming down could indicate utilities going higher. So that's something for us to watch. That's a weekly chart. Daily chart on the utilities XLU points to a very interesting pattern that when it bottoms and it reverses higher, it tends to do that in a W shape. A slightly lower low from the previous low, like we saw in December, 41.47 to January 41.18, a W shape, kind of a double bottom with higher low in RSI, and then it starts reversing higher. Same thing happened in May into early June, 43.24 to 42.79. That was a W shape pattern, and then from there broke higher. So if we do get a W shape again in XLU, rebounding right off that test of that trend line, joining the higher lows, then expect this to hit maybe its 50-day, maybe at 44.77. We already got 0.53% upward move on Friday, and then come back to form maybe a lower low. Maybe it retests that 42.79. like we see in the May to June or in the December to January. And then that would be an awesome buying opportunity in utilities if that could be the W and the break higher towards 46 and more is what you're going to watch. From the technical target of the Dow Jones Industrial Average, that the top 30 stocks that are the blue chip stocks, that had an inverse head and shoulder pattern. So we can see this beautiful neckline at 49,800, a left shoulder and right shoulder identical, symmetrical at 48,700, and the head at 45,100. A 45,100 to a neckline at 49,800, you're talking about roughly 4,700 points. At 4,700 points to 49,800, that takes us to 54,500. That was a target that was this inverse head and shoulder got met last week. On Wednesday, it got met. It in fact hit a peak at 54,700. And as it hit the peak, we can see negative divergence in RSI, negative divergence in MACD. So maybe the Dow Jones Industrial Average could be reflecting a topping pattern, and maybe it could be on a decline, maybe close out that gap near 53,000, slightly above 53,000, and even come to test its rising 50-day moving average is possible in the Dow Jones Industrial Average. Also, if you take a trend line joining the higher highs, starting all the way from October of last year, That trend line is where it met exactly at 54,700. So it met that rising trend line, it met that inverse head and shoulder target, and from there pulled back last Thursday into Friday. We got to watch if the Dow Jones Industrial Average has hit a near-term top. The financials, the XLF, which is the financial sector spider ETF, also met its target, very close to its target. This cup and handle target, 53.92 down to 47.50 to 53, and then a handle in the breakout. So the measured depth of the cup from $47.50 to a 53 is, you're roughly talking about $5.50. Add $5.50 to 53, the target is $58.50. That was the target, 58.50. It came very close to a 58.40 with negative divergence. Multiple RSI prints are at lower highs. Whenever it climbed, we could see increasing volumes on that climb. However, when it fell recently into late July, see the increasing volume on the fall. Now, as if this turns out to have hit a topping pattern and then coming down, we would expect a test of that 50 period moving average at 54.73 is very much likely in the days ahead, is what we're going to watch. So financials could have topped, Dow Jones Industrials could have topped. And another warning sign for us is to look at volatility, VIX. Here we can see lower lows in VIX levels at 15.18 in June to early July at 14.96 to the low that we saw last week at 14.77. So lower lows in VIX. However, the RSI is showing positive divergence, slightly higher highs, higher lows from what we saw back from June. Similar thing, slightly higher lows in MACD. So positive divergence in terms of higher lows in RSI and MACD as VIX is printing lower lows and testing a key support level at 15 could indicate maybe a VIX climb is possible. A VIX climb typically means the market comes down. S&P 500 and VIX are inversely correlated. So whenever VIX climbs, S&P 500 comes down is what we're going to watch. So in summary, 10-year yield is something we are watching. We know that this is a rising wedge pattern. Rising wedge patterns usually resolve back to where it starts from. So we're watching if 10-year yield breaks down to 4.36. However, if 10-year yield breaks above a key level at 4.8, it could go towards 6%, would be very bearish for the market. So far, it has broken down from the bearish wedge. On Friday, it did print a dragonfly doji, could indicate higher yields in a few days ahead. As the inflation data, CPI, PPI comes out, we got to watch and see, is this now indicating higher yields? Because hot inflation data would indicate higher yields with expectation of a rate hike from the Fed. Small caps are directly watching this because if yields come down, small caps break out. So this is key. If the yields rise, small caps would fizzle out on its breakout, but it is potentially the IWM on a cup and handle. That cup and handle measures to 318, 319 from a cup between 287 to 303. So you're talking about roughly $16 on the depth of the cup. So that's something we're going to watch. In a similar cup and handle on the QQQ, the NASDAQ 100, this is testing a declining channel, test to the top of the top trend line of the declining channel and pull back. But if this is a shallow handle and the breakout from 661 to 728 is $67 is the depth of that cup. Measured target here is 795 if you do break above 728. We will, of course, hit resistance at 745, 747. But if those get taken out and continued climb happens, you can expect AI stocks, the Magnificent Seven stocks, the semiconductor stocks to pick up momentum towards that target is what we're going to watch. On the defensive side, the utilities are testing a very key trend line on the weekly chart. This is a rising trend line of the higher lows. It is rebounding off that level at 42.9, a slightly higher low from the 42.8 we saw towards early June. That said, negative divergence indicates there's a possibility this could break down. If it breaks down, though, we're talking about a 42.8 to 47.50. That's roughly $4.60. $4.60 subtracted from 42.80 takes us towards 38.20. So we could be, headed a lot lower if this breakdown happens. However, if we get a rebound, typically utilities rebound in a W-shaped pattern, as we saw in December to January or from May to June, a slightly lower low in price with and from a W and then a reversal. So we might get the tip of the W here, maybe up to 44.77 to test its declining 50 period moving average, and then maybe a slightly lower low from the 42.94. And then that could be a buying opportunity. So anywhere from something below 42.9, maybe a retest of the 42.79 could be a buying opportunity in utilities if that's the W to kind of have a climb higher. Dow Jones Industrial met two key targets. One is this rising trend line joining its higher highs at 54,700. Also, its inverse head and shoulder target at 54,500. Both targets were met. Negative divergence indicates a near-term topping sign. Both in MACD and RSI means we could see downward reversal, maybe a test of the 50-period moving average at 52,000 for Dow Jones. Financials have also met their cup and handle target at $58.50. It met 58.40 with negative divergence in RSI, like the lower highs in RSI. And recently, while the volume was higher in the climb, now in the decline, volume had a similar strong volume on the decline as we had seen during the climb. So last couple of days were low volume, but we got to see if decline continues on the financials. Financials, by the way, are Treasury yield sensitive. Yields climb, financials do well because the net interest margin goes higher. Especially if you take the long-term treasuries to what we have from the Fed interest rate, Fed rate funds. The Fed funds rate are right now at 3.5 to 3.75, somewhere around 3.6%. So if you have a net interest margin of 10-year yield crossing 5% and higher, that would mean good for financials. However, if 10-year yield comes down, as we said with that bearish rising wedge on TNX, that could mean the financials could have had a top and pull back. VIX is giving us a signal that potentially a volatility climb could be in the cards. It's testing a lower low in volatility, 1518, 1496 to the most recent low at 1477. As it's doing that, RSI is not breaking down to lower low. It's hovering slightly at a higher low. So is MACD, indicating that potentially after testing a key support level at 15 on VIX, we could see a volatility spike ahead. With that, good luck investing. We'll talk to you next week. Thank you so much for listening, and appreciate if you could hit the like button on this video. Thank you much.
We are not registered investment advisors and encourage our users to consult with their financial advisors before making investment and trading decisions. Nothing contained in our content constitutes a solicitation, recommendation, endorsement, or offer by us at Chartsarefun or any third-party service provider to buy or sell any securities or other financial instruments in this or in any other jurisdiction in which such solicitation or offer would be unlawful under the securities laws of such jurisdiction.